Stock dividend. Uh, in cash dividend, we have to pay something to our stockholders. So there is a cash outflow from the company which decrease the stock price uh, and also the value of the firm. But in case of stock dividends, we are not giving any cash to our stockholders. We are just giving them additional shares. So what happens, like our value, for example, this is before stock dividend. Our value was 1000 and we have 100 shares, so value of one share was 10. Suppose we decided to give 100% stock dividend. So now we will have again same value 1000 because no cash enters the organization and no cash left the organization, but we will have 200 shares. So what will be the stock price? Stock price will be 5 per shares. But the overall wealth of shareholders will remain same क्योंकि कोई cash any out हुआ ही नहीं है. So sometimes companies decide to give stock dividend. Usually जब आपकी stock price बहुत ज़्यादा बढ़ जाती है तो आप stock dividend दे सकते हैं. उससे क्या होता है कि stock price drop हो जाती है और एक affordable range में आ जाती है बहुत ज़्यादा investors के लिए. So what happened when we give stock dividend? It increased the number of outstanding shares. Like we just saw, it increased from 100 to 200. Usually a small stock dividend, like less than 20 to 25% is considered a stock dividend. If you own 100 shares and the company declares 10% stock dividend, you will receive an additional 10 shares. So 100 old shares plus 10, you will have now 110 shares. If a stock dividend is between or more than 20 to 25%, it's called large stock dividend. So we have to distinguish both of these things because of accounting purpose. So let's see an example. The Pearson Corporation, a consulting firm specializing in difficult accounting problems, has 10,000 shares, each selling at 66. So total market value will be total number of shares multiplied by selling price of one shares, 660,000. Now company decided to give a 10% stock dividend. Therefore each shareholder will 10% stock dividend. Each shareholder receives one additional shares for each 10 owned, and the total number of shares will be 11,000. So 10% of 10,000 is 1,000 plus old 10,000 shares, in total will make up 11,000. Before the stock dividend, the equity portion of Pearson balance sheet might look like this one. So we have common stock up here, $1 is par value for 10,000 shares. And this makes 10,000. Now we have 11,000 shares, right? So 11,000 multiplied 1 will make us 11,000. Capital in excess of par value. So from previous slide, we know that market value is 66 while par value is $1. So excess is 65. And we have just issued 1,000 new shares. Therefore, excess will be 65,000 plus 2 lakh, the previous excess. Therefore, new excess will be 265,000. We know that the total owner's equity remains the same because no cash enters the organizations and no cash left the organization. We just increase the number of shares. We just divided the pie to more number of pieces, nothing else. Therefore, this 500,000 will remains the same, and now we have to balance our retained earning portions. How we can do that? We have increased 1,000 over here and 65,000 over here. So 65,000 plus 1,000, 66,000. If we deduct that 60,000 from here, we will have 224,000. And this will balance our balance sheet. Now you can read these calculations from here, and this is how our new balance sheet will look like. So first, if there is a small dividend, we have to adjust our common stock. So par value was 1 and we have issued 1,000 new shares and 10,000 were our old shares. So our par value or common stock will be 11,000. We already had 200,000 in excess capital. With an additional 1,000 shares, our excess capital will raise by 65,000 and new value will be 265,000. Previously we had retained earning of 290,000. Because we have to adjust it, we cannot change our totals owner's equity. Therefore, the increase in above two sections would be adjusted by decrease in our retained earning. That's all. Next we have stock splits. It's also similar to stock dividend, expressed in a ratio. For example, a 2-for-1 stock split is the same as 100% स्टॉक डिविडेंड 2 for 1. सो अगर आपके पास पहले एक शेयर था तो अब वो 2 हो जाएंगे. So you got 100% stock dividend. A 3 for 2 split is like each shareholder receives one additional shares of a stock for each 2 held originally. So basically it's 50% stock dividend. Again, no cash is paid out, and the percentage of entire firms that each shareholders own is unaffected. Stock price is reduced when the stock splits, because like stock dividend, stock price is reduced. In stock split also, the stock price will reduce, because the whole company's pie is divided into more portions now. Common explanation for stocks split is by following this link, you can see the history of stock splits by Apple. We know that Apple don't give dividends. Whatever cash they are earning, they are utilizing it to acquire other businesses strategically. Therefore, their stock prices is continuously increasing and at a very high pace. To keep that stock price in a reasonable range and an affordable to a mass of investors, they do stock splits. So in last 40 years, they did a 2 for 1, 100% stock split in around 1987, and then again 100% stock dividend in 2000, and then again 100% in 2005, and what we call it, maybe 700% in 2014, and around 400% in 2020. So you can see like from here, stock was trading around 590, and they split the stock, it came to 92, and again in 2020 stock was trading at 425. They again brought it back around 100 by 4-1 split. So let's check its accounting treatment. So the accounting treatment of a stock split is little bit different from that of a stock dividend. Let's consider again our previous example, this one. So we have a common stock, par value is 1, and there are 10,000 outstanding shares. Common stock is 10,000, then capital in excess of par value is 200,000, then retained earning 290,000. Overall owner's equity is 500,000. So let's suppose we have stock split, and that is 100%, like 2 for 1. So if we had 1 shares before, now we will have a 2, because we had 10,000 shares before. Now our share will be 20,000. So what will happen? The number of shares will double and the par value will be halved. The owner's equity after the stock split will be, so we will just half our par value, right? Or you can do it in another way. So your common stock will remain same, 10,000, but your number of shares increase to double, so you can calculate your par value. Rest will remain the same. We don't have to adjust anything. So stock split will decrease your par value as well. So if your par values has gone up a lot, then you can split a stock and drop your par value. But if the only purpose is to reduce your market price, then you might want to go for stock dividend, because stock dividend do not change your par value. But if you want to do a change in par value, then you would go for a stock split, not for the stock dividend. The last portion of stock dividend is large stock dividend. By convention, stock dividends of less than 20 to 25% are considered as a small dividend. We have seen its treatment. It changes our common stock. It also changes our excess capital and also the retained earning. And stock split changes only the par value and rest remains the same. And now third thing is large stock dividend. A stock dividend which is greater than the 20 to 25% is called a large stock dividend. The accounting procedure for this one is that, for example, we have a 100% stock dividends. So previously we had a 10,000 shares, now they will be 20,000. The par value is $1, so the common account would be raised by 10,000, just like a small dividend. The retained earnings account will be reduced by 10,000. That's all. So we don't have to change capital in excess of a par. We no need to change. So just we need to change a common stock. Previously we had a 10,000 shares. Now we have a 20,000. So we have increased our common stock by 10,000. And now we have to adjust this 10,000 somewhere. We will just deduct it from our retained earning and our overall owner's equity will remain the same. That's all, simple. So a strong case can be made that stock dividend and splits do not change either the wealth of any stockholder or the wealth of the firm, right? Because no cash is coming in, no cash is coming out, so how can the value of the firm or the wealth of a stockholders change? In our preceding example, the equity had a total market value of 660,000. With the small stock dividend, the number of shares increased to 11,000. We have seen that if we give 10% stock dividend, then our shares will be 11,000. So it means that each share would be worth 60. For example, a shareholder who had 100 shares worth 66 each before the dividend would have 110 shares worth 60 each afterwards. So what will be the before? 100 shares and each worth 66. So his wealth is 6600. After the stock dividend, now he has 110 shares and each share worth 60. His wealth will be same in both cases. So stock dividend do not give you any benefit in terms of your wealth increase, or you will not be disadvantage because your wealth will not decrease. So no change in your wealth at all, just now you have more number of shares. Again, after the stock splits there are 20,000 shares, so the stock price is 33, right? So 33 is stock price. Now you have 200 shares. So your wealth is still same, right? In other words, the number of shares doubles and price halves. From these calculations, it appears that stock dividend and stock splits are just paper transactions. Although these results are relatively obvious, reasons are often given to suggest that there may be some benefits to these actions. The typical financial manager is aware of real world complexities. For that reason, the stock split or stock dividend decision is not treated lightly in practice.